bright future. We're talking real money.
Well, Monday through Friday, or Monday through Thursday, or just Tuesday, Wednesday, and Thursday, depending on where you work.
The average American work week now?
You probably do something to make money, or somebody at least thinks you're doing something to make money and sends you a check for it. Then
direct deposit, please.
Other times you're thinking about things you might do with that money. What?
I just think it's funny. Just where the world is today. If you're lucky, it's Tuesday, Wednesday, and Thursday. So, yeah. Okay.
Have you noticed that the pandemic sort of changed things?
We talked about this before, because Americans have been criticizing the French, saying, well, we work way more than they do.
Not anymore.
Really? I'm not so sure.
No. Anyway, but the point I'm trying to get to, in a roundabout manner, is the fact that in the course of your life, money is a pretty big deal. And you need to know what's going on with it. It's kind of important. And to help you do that, we're here to take your calls at 855-935-TALK, 855-935-8255. But it also was a recent topic in AARP, the magazine. I forgot that's its name. It's actually called AARP, the magazine. The magazine of the AARP. And this was a piece entitled, it was a great piece. I really, really liked it. So much that when Tom showed it to me, I went, we got to do a whole show on it. 2 hours.
Which basically you never do when I bring up an idea. So
no, never. This is the first time in like 32 years. And it's the issue is entitled, How Well Do You Know Your Money? And in the last episode or hour, we talked about some of the things about the earning and the spending of it. Mm-hmm. In this episode, we want to talk about the wealth part, the building the wealth and then the taking it out in retirement thing. And to start, there's one thing that many of us have wealth embedded in. And we may not be good investors, but those of us who are homeowners often have some wealth. But the question, Tom, is if you were to sell your house today, how much cash, not what would you get for it? No. How much cash are you going to walk away with?
And this is, I make this mistake because if you looked at my net worth spreadsheet, it shows the value of the home, shows the mortgage I have, and what's left is what I've got. That ain't going to happen. And by the way, the same is true in your retirement accounts. Because remember, you may have saved all that money in a retirement account. When you take it out, you're going to pay tax on it, so less goes into your pocket. When you sell a home in the great state of Washington, you end up paying out somewhere, depending on the kind of deal you can negotiate.
And it depends on whose numbers you're using.
Yeah, exactly. But somewhere between 8 and 10% of the value of that property, that's a fairly significant amount. So it reminds me of a couple things. First of all, if you're getting ready to sell, you should negotiate hard with the person who's going to list your property, really hard, because this is a major transaction. And number two, if you're sort of keeping track of your net worth, you got to know what you're going to walk away with. That's the real number.
Yeah,
by the way, it's not
that's the net.
Yeah, it's not just paying the realtor, by the way. You've got excise tax. There's a whole bunch of other sort of expenses that go along with this.
And when we're talking a number, I mean, when you're talking 8 to 10%, and what are home prices? I mean, you're looking at $1 million.
Yeah, I'd say that's probably about average. I mean,
so we're talking
$100,000
in fees and taxes and things that are just sucked out right off the top.
And this is, so as I say, it's important to know this. It's important to consider this when you're looking at retirement, because a lot of people say, well, I'll take a bunch of the money from my home. We'll live someplace smaller. It'll be less expensive, and I'll end up with all this cash. Huge, huge decision there to be made. And as I truly believe, negotiate in today's world, because not that long ago, there were more realtors than there were home deals, I think, or home listings. Or
more realtors, more real estate agents than grains of sand on the beach, than planets in the galaxy. There are a lot of real estate agents. I mean, really, estate agents. But negotiate, because the biggest thing you can negotiate, you can't negotiate the taxes, but you can negotiate the commission. That is negotiable. 855-935-TALK. Call us with your questions about money.
Tom and Don are talking real money.
Do you suffer from hodgepodgeitis? I'm Don McDonald, and hodgepodgeitis is a disease of your investment portfolio whose symptoms include lots of stocks, loads of random loaded mutual funds, and maybe an annuity or two. Most who suffer from hodgepodgeitis dread opening their quarterly portfolio statements. They feel lost and confused. Investing seems overwhelming and the financial future uncertain. If you believe you suffer from hodgepodgeitis, see a 100% fiduciary investment advisor immediately. A proper diagnosis is the first step to creating a portfolio with a purpose based on a personal plan. Start on the road to recovery now by scheduling a free meeting with an Appella advisor at TalkingRealMoney.com. There is no cost, obligation, or high-pressure sales pitch. Take the first step at TalkingRealMoney.com or call 800-386-3004. Hodgepodgeitis is not a real disease, but treating it has been shown to improve mood, reduce fear, and even lead to a brighter financial future. Results may vary.
Your guides to a really great financial future. Tom and Don are talking real money.
We want to help you know the things you should know about money, because there are a lot of things you should know, and that's the topic of today's show. The things you need to know about money, but the things you really need to know, only you know what they are. So to tell us what they are and let us help you with them, you need to call us at 855-935-8255, like Dave did. Hi, Dave. Welcome to the show.
Hi, gentlemen. I have a question for you. I bought a Vanguard fund, which has really done not too well at all, VWUSX, and it kind of goes into something against what you guys recommend because it's very tech-oriented. Over 5 years, it's up 18.9 versus the index of SPY, which is up 53%. And I guess I'm just wondering, would you folks suggest that I would maybe sell that at this point and just get into an SPY or one of your ideal portfolios, just stay with this as it comes back up?
Dave, it's an actively managed fund. We are not fans of active management. Active managers can sometimes win.
Even at Vanguard.
At Vanguard. Sometimes they win, and sometimes they lose. More often than not, they lose.
Yeah.
They tend to lose on average by a pretty large margin, by the way. So you should be, with all of your money, in index funds and not SPY.
And it only
not SPY.
Well, not the Standard & Poor's 500.
No, not only.
Wow.
In other words, I was going to say make sure it fits into your overall portfolio asset allocation. Do you have a hole there that needs to have this group of stocks in it?
I doubt it.
I do need a good broad diversified SPY type, S&P 500, I thought.
But do you? Let's talk about what do you tell us what other funds you have in your portfolio. What kind of funds?
Well, okay. I would say they're pretty much, as you would suggest, they're pretty diversified. I mean, I've got like DVY, and I have like SPY. So most of those, and then I have an international as well.
Okay,
so I thought I was doing.
If you have DVY and SPY, you have no diversification. You have 500 stocks because they both own the same stocks. It's just that DVY, the Select Dividend ETF, owns fewer of them, but it's the same stocks.
Okay, and this is always where the rubber meets the road when people say we're doing what you say to do. No, and I hate to be sort of argumentative because that comes later in the day when I referee high school boys soccer.
In
the
the
reality
rain.
is you are not in the rain. You're not, because you don't own enough U.S. small cap value. You don't have enough international small. You don't have all these other parts. You've got to have a portfolio that takes in all of these things, because we never know which one of those things is going to be good or bad. And when you own them all, you've reduced the volatility and actually made a little bit more money. So my suggestion would be to get a review of all this, to have somebody look at it, third party, somebody else, and say, no, you're missing this, because as Don pointed out, the two funds you have mentioned hold a very similar basket of stocks.
Yeah, they're basically the same funds for all intents and purposes. It's just they're more dividend payers in the iShares. What's the international you hold?
I actually do not actually. Okay, I think it's VWIGX, I believe. Wait a minute.
Yeah, that's the active.
Again,
that's another actively managed fund.
International growth.
Yeah, that's another actively managed fund.
So your whole portfolio is basically large growth companies, when the reality is the more productive firms have been small value companies. We don't say not own growth.
No, you
but
should.
We say you got to own the other parts too, which you do not have in your portfolio.
You're not well diversified and you're paying too much. Whereas you could have a Vanguard International Index or a global index like VT and pay less than 0.1%. You're paying on average about 0.4%, or 4 times more than you'd pay with index funds, and you're not doing as well as the index funds have done, or you haven't done as well as they have done. So you kind of need a rethink of everything a little bit. It's not that they're bad. It's just that it's not what we suggest. It's really not.
Even at 3 times as much, do you want to pay $12 a gallon of gas or 4?
Yeah.
So your model portfolio on your website would suggest some of those that you're discussing now.
Yeah.
Yeah.
Which are much
we
more
have a very simple 3-fund, 2-fund portfolio that will cover more bases than you have covered now by far, by a huge margin.
And if you want to get more complicated, you can go to Paul Merriman's paulmerriman.com. He's got under his portfolios 10 funds, 4 funds. He's got it all. So how hard do you want to work? It's all there for you.
That's a lot of funds. Good luck to you, Dave. Thank you so much for calling. We really appreciate it. 855-935-TALK is the number here. And Sylvia, you're up. Welcome to the show.
Hi. Thank you for taking my call. I'm following up first. I talked to you back in June about my First Allied / Cetera financial advisor, and you said she was probably acting as a fiduciary, and that I should follow up with her and see if she had electronically traded funds or whatever the other kind, index funds.
Oh, index funds.
Exchange traded.
Exchange traded. Okay, yeah.
Traded funds.
All right.
So anyway, so I did, and she didn't answer me. So I went
what do you
home
mean
and
she
I
didn't
looked.
answer you?
Wait a minute, yeah.
Well, I'm not
Of them,
following. You
we
called your financial.
And
You told me to talk to my financial advisor because you said that I could get better service and better funding through your service, through Appella Wealth.
Or other people. What did you discover you had when you went back and looked at your statement after she didn't answer you? What did you find you had?
I have mutual funds. They were all mutual funds. There's no electronically traded funds. She didn't offer me electronically traded funds. And
Okay,
I believe there are some.
Can you give me the names of any of the funds you have?
But no, it doesn't matter because I took your advice and I went and called Vestry.
Oh, okay.
And I rolled everything over. I just wanted to tell you, you were correct. That she was a fiduciary, but no, she was unable to give me similar rates or similar funds to what you could get through.
Right, which means she probably was selling product too for commissions. That would be my first guess, but without knowing for sure, without seeing anything.
I know she sells life insurance, so she sells products.
Yeah, so she's not a 100% fiduciary. That's the difference.
But you were right, you were right.
Well, thank you. Thank you for the update.
You asked me to follow up.
I appreciate that so much. Thank you.
You are so welcome. I appreciate your advisor, Sean. He's been very, very patient with an old woman. So now I'm in. Schwab is my custodian, and I've rolled over all my funds. And I also came on some money, and I put it in a brokerage account, part of it. But now I have $20,000 or $30,000 that I was thinking of putting it in a CD of some sort or a high-interest savings account. But the CD, it looks like they're brokerage accounts if you go through Vanguard. Am I correct?
Well, if you go through Schwab, you'll get brokered CDs, but that's great because the brokered CDs pay very well and have the same insurance.
Tom and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
Hi there. Welcome back. 855-935-TALK. That is our phone number, and we, of course, have a line open for you. You can also call that number 24/7. If you have questions for us, we'll answer them on a future show. And one more thing. Today, our subject is things you should know about money. And one of the things we've just been talking about with people is proper diversification. And Tom, do a lot of people know how much stock they have in their portfolios?
No, it's fascinating. When we meet with people, generally I will ask them. They have their statements with them, and I'll say, what's your stock to bond ratio? They start pulling at their statement. I go, no. What do you believe it is? It's a fascinating discussion. They go, can I just look at the statement? Then I'll know. And this is something you really need to know at any stage of your life.
Yep. I
How
know
much
mine.
in stocks? Yep. I know mine too.
Yeah.
What's yours?
70-30.
Yeah, I'm 80-20.
Because he's younger than I am by like a year.
Not by fractional margin. So, I mean, the reality is all you got to do is look at your statement. On many of the statements, they have a table or pie chart. It's right there. You can look at it and know.
A pie chart? You mean it's that
Yes.
clear? It's like coloring?
It's like, then you could even color it in if it wasn't in color. But you got to know that. You got to know stocks, bonds, and if it's cash, you got in there too. I mean, you just have to know that all the time.
And then, though, really then, we should dig deeper. We need to dig deeper because it's like Dave who called. I've got the kind of things you guys say I should have. But diversification is not just stocks and bonds. Diversification is stocks and bonds with the right mix of stocks. And this is what's so important.
Most people miss this. It's about 85% of the investable money in stocks in the U.S. today is in U.S. large cap.
Which means the bulk of your money's in Apple and Microsoft.
Yeah. Oh, huge. Yeah. As I mentioned on last week's show, it's 13% of the S&P 500, maybe more after this week. So you really want to make sure it's spread around more. You've got to have small. You have to have value. You've got to have international, the same sort of asset classes with international. You should have emerging markets. You should have all those things in your portfolio. Now, is that easy? It kind of is in today's world. Mm-hmm. I think we just mentioned that we give away free portfolios. Paul Merriman's got, there's all kinds of places to go read up on this. And you find somebody who has good advice about passively rules-based managed index type of funds, not actively managed, low expense. You build the right portfolio. You might have to rebalance it from time to time if you're doing this on your own. But that, you've got to know that, especially if I would say if you're 50 plus, because you're getting closer to retirement and you could make a big mistake at, say, in your early 60s, be way too committed to one part of the market, have that go down a lot, and you don't have the time to recover necessarily. So that's a huge thing.
I'm going to ask you a question, and I don't know if you know the answer, but
I hate
it's
that.
live. You were just at DFA, Dimensional Funds,
That's right.
in Austin. I know DFA has a fund, a mutual fund, that covers all the bases with an overweighting to small and value. Do they have an ETF yet that does that?
They do not.
Okay.
They do not. That I do know.
Does
the answer.
anybody
but
have
there's one
that?
available? Yeah.
Does Avantis? I forgot.
AVGE.
AVGE. Right.
Yeah,
So
you could go
there's,
own that.
There's a
one
way.
fund.
What exactly? So you
It
could
takes,
literally
and it's
have.
cheap. Yep.
You could have BND at Vanguard.
Yeah.
And AVGE at Avantis,
that's it.
and that's all you need.
It's a pretty good portfolio. It's not quite as sophisticated as when we do this for a living, but that's a pretty good portfolio.
Yeah, but for
Really
somebody
is.
who's just getting started and looking for proper
Absolutely.
diversification.
Huge. It'd be better than what our previous caller had.
Oh, much better.
By far.
Yeah, Dave, there you could go. You could go that way. Just do that.
If you just want to make it simple. So
Yeah, okay.
I think some people don't trust that. They feel like it's all my eggs in one basket. Like, why am I in one fund?
Yeah.
It's not all your eggs. It's like 9,000 baskets or 10.
Well, what?
They got a lot of stocks in
AVGE
there.
is not that big. AVGE is. Let
I
me
don't know
look
what
it up.
it is, but
Hold
it's
on.
a lot.
Hold on. I'm going to pull it up. Talk. Keep talking. Tom, say something.
Oh, okay.
It's your turn. You got to fill.
Get her done.
It is. I don't know how many stocks. It doesn't say.
Tom and Don are talking real money. Reality radio for a really great future. We're talking real money.
What do you need to know about your dough? Call us and we'll tell you here on our show at 855-935-TALK, 855-935-8255, and it's off to Jeffrey we go. Jeffrey, welcome to the show.
Hi there.
Hey.
Hi there. Quick question for you. I was at my financial advisor's about 3 weeks ago, and he suggested I put more, buy more consumer discretionary. And so I picked a fund and said, here's what I want to buy. And he called back or left a note saying, we can't buy this for you. And I said, why not? He says, there's not enough money in it. It doesn't have enough base capital, apparently. And so I picked something else, which is equivalent. Yeah, but my question is...
Wait. Give us the ticker. Give us the ticker. Give us the ticker of the first one. I'm just curious.
Okay, the one is... I'm sorry, hang on.
The one you can't buy because it... What is it?
Yes. IEDI. It's iShares. IEDI.
IEDI. The iShares U.S. Consumer Focused ETF. Okay. All right, go ahead. What's your question?
Well, the question is, and it's also fairly new, so the question is, what are the risks of investing in something that doesn't have a ton of capital in it to begin with? Does that make sense? Because in other words, I think they said it has to have like over 50 million before they'd consider it safe, quote unquote safe.
It's an ETF.
Does that make sense?
I don't know how that would be unsafe because it
should be. It should be.
Well, let's just take it.
Well, let's see if it's actively managed. Hold on. I think
it is. No, I'm trying to figure that out just by looking at it here.
The yield was good, and the expense ratio was fairly decent.
Oh, yeah. They are slightly actively managed.
But let's go back here just again so everybody understands what we're talking about, Jeffrey. We don't buy things like this because we don't do sectors per se.
Well, we don't guess about the future, which is exactly what your guy is doing. He's guessing.
Well, no, Jeffrey took this idea to him. I think
you said your advisor told you to get more into consumer, right?
Correct. More discretionary, yeah.
Yeah, which is guessing about the future. This is not, in our opinion, this is not the kind of advisor anyone should have, because what you have is a prognosticator, which is impossible. Oh, it's impossible?
Well, you can prognosticate,
but not accurately.
But you won't be probability, yeah. Go ahead, finish your question.
Well, that's only. It was basically because I had none. I had zero consumer discretionary, and so the portfolio was out of whack. Basically, it didn't have anything.
No, Jeffrey. What is in your portfolio then?
A small amount of money.
But what's in your portfolio?
I have everything. I have growth. I have small cap, medium cap, large cap.
Then you have consumer discretionary in there. It's in there already. What your advisor's telling you to do is overweight consumer discretionary. Overweight it.
Well, I was actually I was underweighted by looking at the results of the when you get the statements. I was underweighted.
Underweighted to consume.
Basically, I'm sure.
Do you own Amazon?
Wait, no.
Starbucks?
Go back. What? Give me the name of the. Okay, one. Let's. I got to go back to square one here. How much money's in your portfolio? Roughly.
So I want to say in the air.
Yeah, nobody knows who you are.
Nobody's going to find you. Yeah,
no, $2 million.
Okay. So it's not a small amount. This is a sizable sum. What's your biggest? What's your biggest holding? Which fund ETF do you have the most money in?
It's a combination between DVY and VYM.
DYM. Okay, hold on.
Yeah, they're similar. One's iShares, one's Vanguard.
DVY? iShares. Oh, select dividend. Oh my gosh! If you're in those two funds, you are just loaded with consumer stuff.
I have no idea why they would look, what screen they'd look at to tell them that. That's odd.
Okay, but the amount I was going to put in was a minuscule amount anyway, so it wouldn't have made a whole lot of difference. I was just curious what are the dangers of
There aren't any.
Really, undercapitalized exchange traded funds. I can't think of any.
Doesn't matter.
So.
You know, I got to tell you.
Okay.
I think that you're getting just really horrible advice. I really think you're getting horrible advice. I think you're so in the weeds with all these little segments of the economy that the fact that your portfolio is so heavily weighted in dividend stocks, which means you're almost entirely blue chip, and if you're going to consumer focused products, then you're going to be blue chip. I think this portfolio is a mess.
Tom and Don are talking real money. Your guides to a really great financial future. Tom and Don are talking real money.
Before we move forward, let's go backward just a bit to clarify what we believe is diversification compared to what some people who are trying to make themselves seem more valuable believe to be diversification. We do not believe that a properly diversified portfolio tries to sector weight. Have X amount in healthcare, X amount in technology, X amount in consumer cyclicals, X amount in energy, X amount in whatever else, utilities or whatever else it might be. A properly diversified portfolio is diversified among asset classes, not sectors, because nobody knows which sector should be overweighted or underweighted or avoided or whatever it might be. No one, that is called active management or guessing.
And sectors are groups of stocks that have similar characteristics. Large
in their
firms
business.
But large firms.
Those are asset classes.
Asset classes. I didn't mean to say sectors. My bad. I got so caught up in that. Asset classes are categorized by the size of the firm, according to market capitalization, and the size when you compare the market value versus the sort of book value, that determines growth or value. Other than that, when you start to boil down into all this other silliness, it's going to hurt you. It's what's going to happen.
It's got
You're
to
going to make
cost
a bad
you
bet.
more.
Yeah,
and you're making bets. That's really what it boils down to. You may think you're making investments, but in fact, you're making bets. Betting. 855-935-TALK. Jim, you're next. Welcome to the show.
Hi, good day. I'm older and retired, and I'm 100% into dividend-paying ETFs, and I see nothing wrong with that. If I had thought of that earlier, rather than my middle age when we had the lost decade, I'd even tell young people, there's nothing wrong with consumer staples. They're certainly steady eddies.
They are? All right, let's go back to the lost decade. Even your consumer staples in the lost decade did not do well if they were U.S.-based. Almost no segment of the United States market did well between 2000 and 2010. What saved people's portfolios between...
That's why it's important to have dividend.
No, but
quarterly.
Okay, but the dividend is just part of your total return, Jim. A dividend is merely part of your total return. And when we talk about negative total returns, that includes dividends. What saved people during the lost decade, and you need to hear this because it is something that you don't and many others don't want to hear, what saved people during the lost decade was having about half of their portfolio in international stocks.
Which performed very well. And by the way, smaller companies and value companies did well during that era as well.
Yes, but you have to know when to sell those, and you say you can't time the market.
You can't time the market. Do you actually believe you can time the market, sir?
December 21.
Do you believe you can time the market?
Nobody can time the market. That's why I'd rather just take the cash and run.
What cash? 2.5% dividends? How much cash is that?
Well, mine average is 4% with half an international
Okay, so you're making 4.5% when you could have been making overall over decades 10, 11, 12%. Why would you settle for 4?
Huh? if you knew when to sell.
No.
You have to know when to
No,
sell.
that was merely
You just hold
buying
on.
and holding over 2 decades.
Well, actually,
Holy
5
what,
decades.
though? What do
but
you live on? If you want cash every quarter,
You
what
sell
would
out.
live
You
on?
sell a little bit of
You
your
rebalance
portfolio.
the
You
account.
rebalance
Yeah.
and you sell a little bit of the portfolio. There's no need for
What if it's way down then?
So sometimes you'll be selling when it's way up.
I can collect dividends and not sell anything.
you need to be clear on what that.
He's got-
you did a good job, Doug, explaining what a dividend, what that is. It's not free. It's no free lunch.
No, actually, free.
Yes, I know that.
Every time a dividend is paid out, the value of the stock goes down by the amount of the dividend.
There you go.
So if a stock
Yes,
doesn't
but
pay
I
dividends,
keep
it's
Yes,
Yes, sir.
but I keep the same amount of shares. If I was selling, I'd keep losing shares.
no, okay. You keep the same amount of shares, but the minute the dividend is paid, they're worth the exact amount of the
Less.
dividend lower. Which
Yes, but I don't have to sell shares. I keep them over years and years. I keep the same number of shares and still
right,
get
but
money to live on.
that don't grow as much as a company that doesn't pay out dividends. If you had two identical, now stick with me for a minute. You have two identical companies. These are the exact same companies in every way, shape, or form. They're twins of each other. And you have Company A pays out a 3% dividend. Company B doesn't pay a dividend. You collect that dividend, that 3% dividend every year. The other one just grows. They're going to make the same amount of money overall. There's going to be no difference. The only thing is that you've taken out dividends and haven't reinvested any of those, so you're going to have less money than the person who let it grow. And if the other one took out the same amount in dividends that you took out, at the end of the term, the things are going to be identical or
And
darn
here's another
close.
thing to think about, because I think and Jim, thank you for your call. What Jim is really trying to suggest is that a dividend payout strategy in retirement is better than what I think the academic work is very strong that shows a total return strategy, which is what you were alluding to, Don. Things go up, things go down. You rebalance, you take from the winners, put that in your pocket. Market adjusts again, you take from the winners, you put that in your pocket. Yes, sometimes you have to draw after things have gone down. But over the long haul, that total return strategy has been much better for investors than a dividend payout. I'll put
And
it that way.
actually, the company that the hypothetical company that didn't pay out dividends, because of the fact that stocks tend to rise 75% of the years and fall 25% of the years, even if you were withdrawing, you would end up in the company that didn't pay dividends with probably just a little bit more money at the end of the same term, even drawing during bad markets. We get way too caught up in, and it's because people watch too much CNBC or read some of the financial press. They talk too much about how taking money out in a bad market is going to destroy your portfolio. Yes, if you take it all out in a bad market, it's going to destroy your portfolio. But if you're drawing 5% of your assets, we've run Monte Carlo simulations, and we can't come up with a single one if you had equities in your portfolio where you would have run out of money. Not once, even during the worst of markets, because there are more good ones than bad ones. And by the way, that's just financial physics. There have to be more good markets than bad. There must be. It can't be the other way around. It is.
And that's because
if it was the other way around, if there were more bad markets than good, eventually the entire value of the global economy would reach zero. And if the global economy reaches a value of zero, I think almost all of us would have already shuffled off this mortal coil, and the few that are left are going to be eating zombies or whatever for dinner.
we won't be taking Virgin to the moon, I guess, at any rate. So, okay, there you go.
I thought we were going into human sacrifice for a minute when you said Virgin.
No, we're not going to do that. So we don't have time for another call, right?
No.
We're done. We're done.
We don't. I'm so
sorry about that.
I wish we did, because I was really having a good time. I really do enjoy this. I hate to say it. We'll be back in just a minute, though. Don't go away. I'm Don. That's Ron. Talking real money.
Tom and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
And remember, you can call us 24/7 at 855-935-TALK with your questions, or you can send them in or speak them in at talkingrealmoney.com on the contact form. And if you have something that's a little bigger and it needs a one-on-one with one of our advisors, just go to talkingrealmoney.com and click on Meet an Advisor, talkingrealmoney.com.
We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times. Also, as much as you want it, no one can accurately and consistently predict the future, so past performance doesn't tell you a darn thing about what the future will bring. Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial product or securities. Instead, the program is provided as a public service by Appella Capital, a fee-only registered investment advisor. Thanks for listening, and please visit talkingrealmoney.com for more information and disclosures. To keep the lawyers happy.